Hi, I'm TaraLyons with Team Lyons in Royal LePage, and I want to welcome Matt back. Matt,
Hello.
Go ahead and introduce yourself.
I'm Matt Howell. I'm an advisor at PPF Group here in Belleville. Our company has offices in Belleville, Peterborough, and Kingston, and I work the Bay of Quinte region.
And we truly appreciate having Matt here again because he was on last year, and we really appreciate all his information that he provides us. So we have some interesting questions for Matt because, as everybody knows, when you're looking to invest, some things have changed. Maybe, we'll find out. And with everything that's been happening south of the border. So why don't we dig into that? So given the volatility of the markets, the biggest question is, how should Canadians diversify?
Well, I don't know that things change much from one economic crisis to the next, but given today's kind of volatile geopolitical issues and how that affects our markets and markets globally, I think it's important that Canadian investors stay diversified in more ways than one. So we need to diversify across our asset sectors, make sure that we're investing in fixed income, that we're investing in assets, and that we're invested in some alternative assets like REITs in some cases. Secondly, I'd say that geographic diversification is important. Yes, we're Canadian and we're in a tense time where we want to stay Canadian, but our markets here in Canada are very weighted towards specific sectors. So to have exposures to all sectors, we still need to invest in the US and in emerging markets in Brazil and Europe. I think that currency diversification becomes important, especially in a weakened Canadian dollar, that we're looking to invest in US dollars and maybe the euro, and we can do that through exchange traded funds. And sector diversification is very important. So once again, the Canadian market is very resource and financial heavy. So to still have access to technology and healthcare and commodities, that we need to reach outside of our borders in order to stay diversified.
And this may not change for some people because it just really depends on when you sit down with Matt, you're actually going to go through a whole process to find out what type of investor you are. And if you were to take myself versus my husband, Tom, he is more of a risk taker than I am. So, my portfolio is going to look very different than Tom's portfolio. So some of yours out there may not even change, right? Because you're maybe more conservative than somebody else. And that's why it's so important to sit down with somebody like Matt. But again, don't forget, we've come through these times before. We had the financial crisis of 2008. Right? And that was crazy, right? And then we had COVID, and that changed everything all over again. So this is just another little blip that we're going to get through, and it's going to change in maybe 3.5 years, 4. And so, we want to just make sure that you're communicating with your investor to make sure that you're going along the right line.
Yeah, I think it's a great point, and you talked about the difference in portfolios, and it's actually one of the points in diversification is that you manage your risk thoughtfully, right? So if you're conservative, you're going to be leaning more towards fixed income investments. And if you're aggressive, growth-based, you're going to be more focused on stock and equities. And you can rebalance regularly, to kind of manage your risk. And it's a good time for a gut check and say, yeah, where do I sit? Am I really as risk averse as I thought I was?
And while we're talking about investing, I would be remiss if I did not mention that may involve using myself or one of my team members to go out and buy property and see how that also folds into your portfolio. Considering the recent market downturns, what sectors or asset classes might offer resilience or growth opportunities for Canadian investors?
It's a good question, and in the face of turbulence and uncertainty, I think Canadian investors should focus on sectors and asset classes that are poised to things like non-cyclical in nature, so utilities, telecom, healthcare, consumer staples. These are things that we always need in spite of market conditions, right? Growth-oriented sectors, so technology, green energy. There's still a lot of research and money focused towards those sectors. And financials, which are somewhat selective, but especially here in Canada, we can rely on the growth of our financial sector and how it weathers turbulent times and the consistent income through the dividends that are paid. Real estate, an alternative. So you talked about owning property. Well, not everybody can just go out and buy a property. Whether or not the lending environment is right for it, you have to have the ability to get a hold of assets. So you can invest in property indirectly through real estate investment trusts, which provide income, rent checks, just like you would if you were a landlord, except you're a smaller piece of a bigger pie. And fixed income, which has been favorable in 2022, I wouldn't have said fixed income. Things like bonds, lending instruments, and even cash to a certain degree was a good environment. But now it is. Things have come back, especially in short-term GICs and bonds are offering some pretty favorable rates now. So if you're uneasy about market conditions, it's an okay place to be. It's better to make a little money than it is to lose.
And I think that's key right there. You think about that when you're talking about 2022, that's only 3 years ago. And you have to remember, any kind of investment that you're looking at, real estate is usually a long-term investment. We had some short-term investments there during the COVID years, we call them, but it's typically a long-term investment. So people are disappointed after 3 years if they haven't seen an increase in their home. Well, that's long-term. Depending on what you're investing in on this side, that can be the same thing. So that's why, again, it's important to talk to somebody to say, what is the outcome you're looking for when you're making your decisions on what you're investing in? Would that be fair?
Yeah, and alternative investments like real estate and real estate investment trusts, they don't often correlate with the markets. So think of last year. Everything you invested in made good money last year. Real estate investment trusts didn't perform very well, but they not correlated directly with the market, so they don't move in the same way. Right. So this year, real estate investment trusts are poised to do very well, where the markets may not.
How should investors adjust their risk tolerance and investment horizons in light of the current global economic?
Well, I think in today's volatile environment, and in any volatile environment, market-wise, I mean, it's important just to not react with fear or to reallocate your expectations based on your own fears. And then it's about staying adaptable and intentional. So reevaluate your risk tolerance, do the sleep test, right? If you think yourself to be an aggressive investor and you can't sleep at night, or the market conditions are creating undue tension, both on your portfolio and on your own stress levels, then you're probably not invested to your risk tolerance, and you should, get with your advisor and kind of go through those questions again and see where you should be. Risk tolerance is about how much volatility you can handle, not about avoiding growth entirely. Second, you should align your investments with your time horizon. So you should have specific buckets. I just sat with somebody who came into some money recently, he's relatively young, and we were looking at risk tolerance overall, but then through the conversation, they're talking about things that they might need in the next couple of years, but they're not sure of. Going back to school in the next 3 to 5, which is an obvious expense, but there's a little time. So it's more of a medium-term bucket. And then the long term, anything I have left over, I'm going to want to save for my retirement or for a future purchase or for a home. So there's 3 specific buckets in that timeline, 3 specific risk tolerances. So being mindful of, in the short term, the what if money over the next couple of years, holding a lot of cash that doesn't really grow, but it doesn't exactly shrink, or you don't lose it, essentially. And then having a medium-term bucket that has dividend-based investments and financial stock, things like that, that is a little more reliable, because we know we need that money in the next 3 to 5, or could need that money if they choose to go back to school. And then a little bit more of an aggressive chunk for the later, the 7+ years. Rebalance regularly. So a lot of portfolios can be set up to automatically rebalance. Rebalancing means everybody holds a certain amount of fixed income and a certain amount of equity based on their own risk tolerance. Now, in a good year like last year, that portfolio can become off balance because the equity grows so much. So maybe you were 60-40 to start, but at the end of the last year, you were actually 80-20. Well, when things are good, that's when it's time to sell some of the good and put back into the safer. And reversely, when things are down, like right now, they're not really down, but if things are down, that's where you got to get aggressive, right? Because the fixed income side of your portfolio grows because the equity is shrinking, and that's when, buy low, sell high. That's when you want to move money out of your cash and out of your fixed income and back into the equities and wait for that growth to happen. And just stay the course. Don't let emotional decisions derail your long-term plans, right? Even for the person who just retired. Say, now I need this money. Well, you don't need all of this money today. How much of this money do we need today, this year, over the next couple of years if we need to weather a storm? Because that's the amount that should be kept in cash and withholdings, that short-term bucket. So emotionally, we can react to that. My father would.
Yes.
My father's my worst client, right?
Yes.
Because he is retired. And
we hear that a lot in real estate as well. We're like,
Yeah.
oh, what do we do? Because we're seeing this downturn. It's like, but you're not looking to sell right now, so it doesn't matter. It will turn around.
Well, and I think I can draw on personal experience dealing with you and selling a property myself. There was times, because I don't have the same level of knowledge that you do about industry and markets and the real estate market. And there was times I remember meeting you in the parking lot of your office, having a panic attack, and you kind of holding my hand and saying, don't worry about it. It's going to be okay. This is short term. And these are the same, I know this. These are the same conversations that we have to have with people when markets are volatile.
Yes.
They don't know as much as we do. And we don't know the future, but we can hold hands through the tough times,
Yes. Yeah, and that's a great point right there. And that's why it's so important to have somebody that you can feel that comfort level with and know that that's what they're going to do. It's also, don't forget, you should have an appointment with your financial advisor at least once a year, if not maybe twice a year, or that once a year, and then if something does shift or change in the economy. So yeah, never be afraid to reach out.
Yeah, and I just wanted to retouch on keeping that safety buffer again. It's harder and harder to do, but especially for retirees that you're holding 1 to 2 years of income and expenses in cash or safe holdings, so that when markets react, that you're not worried about you're pulling out of your equities in a down market.
Yes.
For us savers, we used to say 3 months. I think after 2008, 2009, we said 6 months, right?
Yes.
You always want to have about 6
Changed. months
of just for the what if. What if you lose your job and there's a transition? Or what if somebody in the family gets sick and you can't go to work for a time? It's always important to have, a 6-month bucket of liquid assets to be able to pull from.
Yeah.
And in the same way with your portfolios in the markets, that if things go awry, that you have cash holdings to pull from that aren't going to interrupt your long-term performance of your portfolio.
And we also don't want to forget that I really, truly believe there should be this other bucket, and that should be, if you haven't bought a home, you want to start saving for one. I have to put that in there.
Yeah.
And I mean, the bottom line is, when you take a look, everything is like cyclical, and whether it's real estate, whether it's investments, they still always wind up going up over time. It's just, what is that time for you? And depending on what stage in your life it is, will depend on what that answer is, which again is why you need to have that check-in, right?
You use the word blip, and I think you're right. This is a tense time. But if we looked at a 30 or 50 or 80-year timeline, we did this a lot in 2008, 2009. It's a blip.
Yeah.
And that the markets, the economy, is sort of like the opposite of gravity.
Yeah.
What goes down must come up.
It's gotta come
and
up.
It's always proven to be so.
And it's funny because we are always discussing that in real estate, because everybody knows up and down, right? So we're always looking at, well, what happened 5 years ago? What happened 10 years ago? Where have we been? And we always know it started here and it's up here, right? And that, again, it just depends on what that time frame is for you. Because there's going to be times in your life where it makes sense to buy a home, or it doesn't. There's going to be times in your life where it makes sense to invest in different portfolios. So that's why, again, you always want to do that check-in. Okay, so we've had a really great discussion today, but if you were to summarize, what would be your overall advice right now as to what to do in this climate?
Well, I think it's the same in all uncertain times, and you're right. Some of the things we talked about just are tried, tested, and true, and still hold true. You got to reaffirm your long-term plan. What's your why? What's your reason behind your why? Is it retirement? Is it a home purchase? Is it education? Is it your kids' education? And adjust only if your personal situation changes. You lose your job or you got a new job. Then maybe it's a reason to take a real look at your portfolio and adjust accordingly, but don't just do it on market reaction. Block out the hype. I think that what we get through the media often is to create a reaction, and emotions isn't a good cornerstone for a long-term portfolio and the value of advice. Use time-based buckets. Make sure that you have the short term and the medium term and the long term worked out. And I think last year, everybody did well last year. No matter who you are, what you were in, you did well last year. And I was talking to my clients that were closer to retirement about, it's time to get more conservative. What do you think, right? And when things are good, it's the hardest thing to do, to say, oh, but I've been doing so well. But 3, 4, 5 months out, you're thinking, oh, thank goodness I made some changes, right? Because the time horizon's changed. Avoid selling long-term investments in a downturn. Like I said, unless your personal situation changes, you don't have a reason to do that. Even if you're, like we spoke about, just retiring now, and markets are down and your investments are down. You do not need all your money today. You need all your money for the rest of your life.
Don't react.
That's right. And we don't think that this is the way things are going to be for the rest of our lives. If it is, I'm out of a job and so are you.
If it is, we're all in trouble.
If it is, we're all
we're all
trouble.
turtling.
That's right. The big what if, right?
Yeah.
And automate and rebalance. So when things are good, rebalance your portfolio to the safer side. And when things are bad, rebalance your portfolio to the more aggressive side, which feels like the opposite of what we should be doing emotionally. And automate. Make sure you have regular pre-authorized payments and that they're still going in, because when markets are going down, that pre-authorized payment agreement, when markets are down, you're buying in a down market. And as far as rebalancing your portfolios, most companies like ours and most firms, most banks, they have automatic rebalancing services where monthly, quarterly, annually, if your portfolio drifts a certain assigned percentage, that it will actually rebalance itself, so that we don't have to think about it when things are up and things are down. And just diversify, like we spoke about in the first question, and be patient. And last but not least, if you need to, go on a news diet. Like I said.
And I love that.
Yeah, the media is created to invoke a reaction in our emotions so that we respond to it, and don't let that be represented in your portfolio, because emotions never align with thoughtful planning.
Yes. Well, I think that's a great way to summarize it. So thank you, Matt. I so appreciate for you joining us again. Thank you for your time. We're going to revisit this every year. I really think it's that important.
Yeah, thank you. Yeah.
Yes. And if you do not have a financial advisor, you need to get one. And of course, I recommend Matt. He's been in our lives for a long time now. And we don't bug you very often.
No, you're good clients.
You pay and leave. Pay and leave. Just don't focus on it all the time. And so thank you. Appreciate it.
Thank you.
Yeah.